Okay, let's dive right into this. Welcome back to The Explainer. Today we're looking at something that is, honestly, a truly fascinating anomaly happening right now in the global financial system. We are seeing a massive paradigm shift when it comes to gold, bond yields, and just the fundamental mechanics of the modern economy as we know it. For decades, the financial world basically operated on a fairly predictable set of rules, but recent data suggests those rules might literally be breaking down in real time. So we're going to map out exactly what the data is telling us to really understand the mechanics of this huge shift.
Now, to figure out where we are today, we kind of have to look back at where we started. Picture this. It's April 2004, and the general financial consensus viewed gold as a complete relic of the past. Take a listen to this quote from a Financial Times editorial published at that exact time. Given the pointlessness of holding gold is irrational in the first place. Talk about a quote aging poorly, right? But it actually serves as a perfect, almost ironic anchor for our explainer today. Because 2 decades ago, the established authorities in the room considered holding bullion to be completely irrelevant to modern finance.
But, let's look at the actual numbers, because the data we have today tells a totally different story. Back when that 2004 article hit the press claiming gold was pointless, the price of an ounce of gold was sitting at roughly $400. Fast forward to our source data from mid-2026, that exact same ounce has surged past $4,100. That is more than a 10-fold increase. This incredible price contrast really sets up the core mystery of what we're looking at today. Think about it. If the financial consensus deemed gold completely irrational, what underlying, powerful forces drove this massive explosion in its value over the last 2 decades?
And this brilliantly illustrates the exact anomaly that financial analysts are literally scrambling to decode right now. The old market rule was incredibly simple, right? Rising yields equaled falling gold. Historically, when government bond yields go up, they offer this highly attractive, risk-free return, which naturally competes for investor capital. And since gold doesn't pay a yield or a dividend, it usually just gets crushed when interest rates rise. But consider the new reality we're finding ourselves in. Rising yields are currently equating to rising gold. In 2026, both of them are climbing simultaneously, which completely defies traditional financial gravity.
So, to understand why these two assets are suddenly moving together in lockstep, we really have to zoom out and look at the broader macroeconomic picture. We are coming off the back of a 40-year cycle defined by one major overarching theme: cheap debt. Understanding this historical context is absolutely crucial for us to grasp how the global economy arrived at this highly unusual, highly pressurized moment.
Let's trace this timeline to see how this whole debt supercycle played out. Back in 1971, the US dollar was officially severed from the gold standard, and that basically gave birth to our modern debt-based financial system. By 1981, mostly to fight rampant inflation, Federal Reserve Chair Paul Volcker pushed yields up to a staggering 15.5%. But from that peak, we saw a massive 40-year slide downwards. It allowed the world to borrow ever cheaper money, culminating in 2020, when yields bottomed out at a microscopic 0.3%. Now, skip ahead to mid-2026. We've got renewed inflation concerns, fueled by surging oil prices and geopolitical tensions in the Middle East, and they've caused yields to dramatically spike back up to near 4.7%. That's an 18-year high. The era of cheap borrowing, it has abruptly ended.
Let's pivot for a second and see how this builds into what market analysts are actually calling the collateral crisis. We've looked at the history, but now we really need to understand the underlying mechanical stress happening inside the bond market today. Because this isn't just about government debt on a spreadsheet, it's about the very plumbing of the entire global financial system. We hear the word collateral thrown around all the time, right? But let's bust the financial jargon and define what it actually means at a macroeconomic scale. In the institutional world, government bonds aren't just benchmark investments. They are the fundamental collateral used to secure and underpin literally trillions of dollars in global borrowing. Whether it's a hedge fund getting leverage from a prime broker to make a trade, or a commercial bank issuing a loan, government bonds act as the absolute bedrock. They're the supposedly risk-free asset that keeps this massive debt-based financial machine running smoothly.
But what happens when that bedrock starts to shake? Well, analysts highlight a pretty dangerous domino effect here. Step 1, bond yields rise rapidly. And because bond yields and bond prices move inversely, step 2 inevitably kicks in. The actual value of those bonds drops. That means this crucial collateral suddenly becomes much more expensive and highly volatile to use. Finally, step 3, institutional borrowing stalls out as liquidity dries up. We're actually seeing this stress build, particularly in Japan right now, where surging yields are creating this slow-building crisis. In fact, some market historians point out that a similar, largely ignored bond sell-off is exactly what preceded the infamous 1987 stock market crash.
Now, this mounting stress in the central bank collateral system isn't just happening in a vacuum. It's triggering a massive macroeconomic chain reaction,
Which brings us to the geopolitical gold rush. Global institutions and central banks are waking up to the vulnerability of their traditional financial safety nets, and they are moving aggressively to protect themselves.
According to the data, we're seeing BRICS nations and countries all across the global south actively stockpiling massive amounts of gold. Why the sudden rush? Well, they're looking for a new form of neutral collateral. Unlike government bonds, gold offers some very distinct advantages in today's volatile climate. There's no counterparty risk, it literally cannot be frozen by foreign policy decisions or sanctions, and there's no single government issuer who can just devalue it by printing more. They see the traditional fiat and bond systems under immense pressure, so they are pivoting heavily into physical, neutral assets.
Now, what's really interesting about this is the historical parallel analysts are drawing. When folks try to make sense of this bizarre 2026 market behavior, where gold and yields are just rising together, financial historians keep pointing their fingers backward. They're specifically looking for echoes of the 1970s to try and understand what might happen next. If we compare the data across these two eras side by side, it's pretty wild. In the 1970s, we saw a massive yield surge from around 5% up to 15%. Yet, despite higher yields normally crushing gold, the gold price exploded from $88 to roughly $880. That is a tenfold increase. Now look at the 2020s era. Yields have surged from 0.3% up to 4.7%, and gold has climbed from $1,600 to well over $4,100. This structural parallel, gold rising aggressively despite spiking yields, is exactly what is fueling some highly speculative, totally non-consensus forecasts out there right now. Some analysts are boldly projecting gold could eventually reach an astonishing $40,000 an ounce if a similar tenfold multiple plays out today. No way, right? But that's what the math suggests.
And it's not just the physical gold metal itself catching a massive bid. The broader precious metals market is totally reacting. We're also seeing significant daily growth in miner ETFs. Funds like GDX, the Junior Silver Miners ETF SILJ, and GDXJ are posting daily gains of roughly 3 to 6% in the data provided. Physical silver itself is also nearing $60 an ounce. However, analysts do note a really important caveat regarding silver. While it is seeing a structural shift in interest, its bulkier physical storage requirements mean it might see a much slower rate of institutional adoption as collateral, especially when you compare it to the much denser, easily stored gold.
So what does this all mean for you? Why should the everyday focused learner even care about this? Well, we have to keep a close eye on these key inflation proxies moving forward. M2 money supply growth, the expansion of central bank balance sheets, and Brent crude oil pushing past $100 a barrel amid these geopolitical conflicts. Because these aren't just abstract numbers on a screen. As yields rise and these inflation metrics climb, the cost of borrowing permeates the entire economy. This directly impacts the interest rates on your mortgage, the rates on your credit card debt, and even the cost of basic goods. What happens at the macro level with global collateral? It absolutely eventually hits the household budget. So the crucial point we're left with is this. We're witnessing a moment where the fundamental rules of the global financial system actually appear to be fracturing. Does this current cycle definitively validate gold's permanent return as the ultimate neutral reserve asset? Or is this massive price surge simply another temporary false alarm driven by geopolitical anxiety? The data is shifting rapidly, and what happens next is going to redefine how global institutions value money and risk. Thank you so much for joining me on this explainer, and I'll leave you to ponder that exact question until next time.